Okay, so now we can get started. Welcome to our second session, management accounting revision. So, in our last session, we did look at this mock exam, and we are still looking on it. We need to look at areas that we did not cover in last session, in our session yesterday. So please help me out with the last thing that we were now doing. So we had covered all this. Anyone who still remembers, we're on number what? From the team that was there yesterday, anyone who still remembers, the last question we did was number what? Hello? Anyone who still remembers the last question we did? But I recall we had covered this, we had covered all this, we had covered this. I think it was this one. Can you confirm this is the last question we did? I think if we can go to our Excel, it can help us with the confirmation. So the last calculation we did was for the high-low method. So that is the last question that we did. So now let's get into business. Now let's get busy. Now let's get busy. So from that question, what is the next? What is the next question? So this one we'd already covered this. So we're now going to the next question. We're now going to the next question. So using an interest rate of 10% per year, the net present value of a project has been calculated as 50. Okay, that's our NPV. For the interest rate, if the interest rate, is increased by 1%, the NPV of the project falls by 20. What is the internal rate of return? So remember the IRR. So the internal rate of return, maybe let's just have a quick recap. Remember, this is not, the purpose of the revision session is not just picking the answers, but also having a general understanding of the ideas surrounding the question. So let's have a quick recap of the investment appraisal techniques, because we don't know, maybe we might not get another question on investment appraisal through the revision session. So investment appraisal, just a quick recap of this. So under the investment appraisal techniques, these are the techniques that we use to determine which investment is worth investing in. So if you are comparing a number of investments, which one is worth investing in? So we can have the following techniques. We have the payback period. So we have the payback period. So the payback period looks at the period which we are going to recover our investment. So if the payback period is, per se, 1 year, we are saying if we invest, how long does it take to recover what we have invested? So if the period is 1 year, we can recover our money in 1 year. I think this is what a lot of people tend to look at. Before you invest your money, you need to know, when will I get my money back? So the moment you're thinking of, when do I get my money back? That is the payback period. So the payback period, I would prefer a project with a short payback. I invest the money in the morning, then in the afternoon, I already have it back. So the payback period is the period you take before you can recover your initial investment. Then besides the payback period, we also have, besides the payback period, we also have the accounting rate of return. This is equivalent to the return on capital employed. So it tends to look at, okay, if we invest in this project, what is the overall return? What is the overall profit we are going to get at the end of, considering all the years the asset is going to stay in the business, the investment is going to stay. How much profit is it going to give us? So it tends to look at all the profits expected from the project. And from that, let's highlight this one deals with profits. It looks at the return in terms of the profit. How much profit we're expecting in the asset's life. So we choose a project with a higher return. It means it's able to give you more profit from your investment. So the return tends to look at, from what I invested in the company, how much will I get back? From what I invested, how much will I get back? Then from the return, the accounting rate of return, we also have the net present value. So the net present value, we are saying, we are expecting that the project will give us cash flows, or it will give us returns. But if we are to take into account the time value of money, how much are those returns worth today? I think for someone who is in an environment like Zimbabwe, you would understand the power of the net present value. So let's think of us dealing with Zig. Let's think of us dealing with Zig. Then you are told that, okay, this project is going to give you, we have year one, and we have year two, we have year three, and maybe we have year four. So these are the years. So for year one, we're expecting that the project will give us 120,000 Zig. Year two, it will give us 140,000 Zig. In year three, it will give us 150,000 Zig. In year four, it might give us maybe 34,000 Zig. So before I can say, no, this one is the best investment, I might say, okay, yes, the project is going to give us all that, but how much is that in today's terms? Because this can be affected by inflation. The 150,000 can be worth $5 by that time. So I would want to know what will be the value of that 150,000 if I was to get it today. I'll get it after 3 years, but what is it worth today? So a certain project might look lucrative because it has returns that are coming after 5 years, but you can't really base on that, because in 5 years, a lot of changes can take place. So you need to know what is that amount of money worth in today's terms. If you had to receive it today, how much would it be in value? So that is the net present value. We are looking at the returns from this project. And then we discount them to present value to say, if we are to receive them today, how much are they worth? So that's the net present value. We would accept a project if it is a positive net present value. So this is a revision session, not the actual lesson for this. So we're just going to be talking about it in brief. Now let's move on. Besides the net present value, we have the IRR, which is the internal rate of return. So this looks at the rate which will give us a net present value of 0. So this is more like the point at which we'll break even. So the rate that we can use for us to break even. So the IRR, we prefer a project with an IRR rate which is above the cost of capital. So these are the methods that we normally talk about. So the question is asking about the IRR. So let me have the IRR formula down. So the IRR says that if you're calculating the accounting rate of return, so the internal rate of return, you say A plus D P over P plus N. But I'm sure you already know this one. This is the formula for IRR. So it says the rate giving us a positive NPV plus the difference in rates, then open bracket, the positive NPV over the positive minus negative NPV, which becomes the positive plus negative. The original formula is a negative, but since the negative NPV will be also negative, it becomes a positive. What do I mean by that? Let's say if the positive NPV I think they mentioned something about the NPVs. Let's go and check. But okay, so if the positive NPV is, let's say, 120, and the negative NPV, the negative NPV is the negative NPV is minus 50. So the original formula says that if you're calculating the IRR, you say positive NPV over positive minus negative. But if you say positive minus negative, that's 120 minus. The negative NPV is minus 50. So if you say minus in maths, it becomes positive. So the short way of doing it, you just add the positive and the negative NPV, ignoring the negative side. So IRR, that's the rate giving us a positive plus the difference in rates, then the positive NPV on top. Then below, you say the positive plus the negative NPV. Okay, with that in mind, let's now go to the question that has been asked. So using the interest rate of 10%, that's our cost of capital per year, the net present value per year, the net present value of a project has been calculated as 50. If you are using 10%, our NPV is said to be 50. If the interest rate is increased by 1%, the NPV falls by 20. Okay? If the interest rate is increased by what happens? Yes. If we increase our cost of capital or interest rate, if we increase our cost of capital or interest rate, the NPV falls. So increasing the cost of capital actually reduces the net present value. So the question is, we want the cost of capital. We want the cost of capital that will give us an NPV of 0. We want the cost of capital that will give an NPV of 0. So the higher we increase the NPV, sorry, the higher we increase the cost of capital, then the lower the NPV. From the question, we are told if the cost of capital is 10%, then our NPV, if the cost of capital is 10%, our NPV was said to be, was it 50? I think it was 50, yes. Then if we increase the cost of capital by 1%, the NPV falls by 20. So if we increase by 1%, it means if it's now 11%, our NPV falls by 30, it means by 20, it means it will be 30. So it means if we increase it again by another 1%, 12%, our NPV falls to something like 30 minus 20 to 10. If we increase by again 1%, then our NPV is negative. So now going to the question. The question was then saying, what is the IRR? The IRR is the rate that gives us an NPV of 0. So did you see as we were increasing the cost of capital, our NPV was falling. So we want to know at what percentage are we going to get an NPV of 0? So the IRR gives us an NPV of 0. Is the rate that gives us an NPV of 0. So the IRR is the rate that is going to give an NPV of 0. So since at 12%, the NPV is still 10. It means so our IRR is slightly above 12%. Because as we were increasing by 1%, it was falling, NPV was falling by 20. So let's go to the answers and see if we cannot deal with it by just, so what is the internal rate of return? The internal rate of return can't be 7.5. Why? Because at 10%, our NPV is 50. Okay, let's move. So what is the internal rate of return? 7%, it can't be 7.5. Why? Because it should be higher. Because if we lower the rate, the NPV is actually going to become higher. But remember, as the rate increases, the NPV falls. So it's falling. Every time we increase the interest rate by 1%, it's falling by 20. So if it was at 10 and it was giving us 50, if we increase by 1% to 11, it was giving us NPV of 30, of which IRR gives us an NPV of 0. So again, 11.7, it can't be. Then 20, it can't be because 20 is too high. So I think 12.5. By inspection, 12.5, yes. Because since at 12%, our NPV was 10. And we can still even use proportion. We can still use proportion to say every 1% that we were increasing, NPV was falling by 20. So it means if we increase by 0.5%, from 12, if we increase by 0.5%, which is if we increase to 12.5, it means our NPV would also fall. It was falling by 20% for every 1%. So it means if we increase by 0.5%, it should fall by 10. So from 10, if it falls by 10, it gives us 0. So now let's move on. Any questions on that? IRR is the rate that gives us an NPV of 0. Okay, so the silence means we are in agreement. That's the rule here. Silence means yes, everything is all right. So now let's move on. A factory consists of two production departments. We have production department P and Q, and two service centers, X and Y. The total allocated and apportioned overheads for each is as follows. So P, Q, X, Y. These are departments. PQ, production, XY, there's a service. So it has been estimated that each service cost center does work for other cost centers in the following proportions, okay? The reapportionment of service cost centers to other cost centers fully reflects the above proportions. After the reapportionment of service cost centers, cost has been carried out. What is the total overhead for production cost center P? So remember, overhead analysis, apportionment of overheads over the cost centers, apportionment of overheads over the cost centers. So how should we apportion the overheads in this particular instance? How should we apportion the overheads in this particular instance? So the first thing is let's go and have the departments PQXY. Those who can take pictures, please, can you help me out? Can you take the pics? Then you will help me out with the amounts. Okay, I hope now you have taken the pictures. So we have our departments. We have our departments. Department P, we have Q, X, and Y. So having these departments, we were told about the overhead, the production overhead. Before secondary apportionment. So we can say the production overhead allocated before secondary apportionment. Can you help me out? How much was the overhead for P? You guys, can we work as a team, please? How much was the overhead for P?
95,000.
Can you speak up, Faith? You said what? It's 90?
95,000.
95,000. Then for Q?
82,000.
82,000. For X?
46,000.
46,000. Then for Y?
30,000.
30,000. So X and Y are said to the service departments. So with the assumption that you did overhead allocation, you should know that we have production and service departments. So we have primary apportionment and secondary apportionment. So secondary apportionment is what we are doing here, where we are reapportioning the service department to the production department. So we want to do secondary apportionment. So for secondary apportionment, we want to reapportion the service department to the production department. So we need a base for apportionment. So the first service department we can apportion is the department Y. So if we are apportioning the cost for department Y, it means we are removing it from department Y and we share it among the other departments. We remove it from department Y and we share it to the other departments. So let's go to the question and see how the other departments were getting services from Y. So P was getting 30%, then Q was getting 60%, then X was getting 10%. So please, then for the other one is 50-50. So I don't need to come back again to this page, so help me memorize that. So for Y, we are going to split the cost for Y among the other departments. And it was 30,000 and 10% is being given to department X. Then department Q, it was getting that 60%. Then this was getting something like 30%. Sorry, it's supposed to be of 30,000. I don't know what I did for this one. Supposed to be 60% of 30,000. Remember, we are sharing the cost for department. We are sharing the cost for department Y among the other departments. So if you had to add up this, they should give us the 30. So so this one is correct. This one is it. So 30% of 30 years. So after you have shared, we have apportioned. So we have eliminated department Y. Now we have to eliminate the next department, service department X. So for eliminating service department X, we have to eliminate 49,000. We are sharing the 49,000 over the production departments. We were told that service department X was providing 50% of the services to these departments. So you multiply by 50%, that's half.
Is it 49,000 or 46?
So that's a good question. It's supposed to be 49. Reason being, if we go to the question, service department Y was providing a service to department X. Let's go to the question. So it has been estimated that each service cost center does work for other cost centers in the following proportions. Then percentage of service cost center of Y to X. So we have service cost center Y providing a service to service center X. So if Y is providing a service to X, when we share the cost for department Y, we also allocate part of the cost to X. Because Y is providing a service to X, we are going to also give X a share of Y's overhead. Then, when we are now sharing the service for X, we share the amount inclusive of the service cost we received from Y. The 3,000 was the share that X received from Y. So if we had to add it to 46, we get 49. So that's where we're getting the 49. It's because Y provided a service to X and 10% service to X. Now, when we are doing the apportionment of the department X, we apportion the total inclusive of what X received from Y.
Okay.
So it means overally, now this department ya ndamufonera ndikati angangu kana zvayashaika ngachitongotsvaga imweni wozi kuti pasare pakadaro hazvisisi. Okay, so the question was asking, for department, which department? Cost center P. So for cost center P, our calculation was, is it this one? 128? I think it was this. Yes, that's correct. Let's move on. Who is that? G company uses job costing and uses job costing and uses a standard net profit markup of 20% on total cost to calculate the selling price. The selling price of job AM is 672 and the fixed overhead cost of the job is 340. What is the variable cost? So what is the variable cost? So what are we given? We are given markup and selling price. By the way, markup and selling price, these don't work together. Even from our FA, I told you this, markup goes with cost. Then, because the markup is the profit in the cost. So markup is the profit in the cost. But margin is the profit in the selling price. Markup is the profit in the cost, margin is the profit in the selling price. So we can change the markup to margin. Let's change the markup to margin. So the markup was given as what? So the markup. Yes, what was that, Bowen? You said how much?
20.
20 is the markup, right?
Yeah.
So if it's 20%, that's 20 over 100. If we change that to margin, it becomes what? To margin, it becomes 20 over 120. Remember, to margin, we add. Anyone with a problem with this? To margin, we add. Okay, so we are given the selling price. So if we say the selling price minus the margin or profit. Or no, in fact, if we say the margin times the selling price, it will give us the gross profit. The margin times the selling price, it will give us the gross profit. How is this of help to our question? Let's go and read the question again. I was just downloading the knowledge that I have regarding that. So they are using job costing and a standard net profit markup of 20% on total cost to calculate the selling price. The selling price is 672. And the fixed overhead cost is 340. What is the variable cost? We're told of the markup, and we are told of the selling price. Even if we work out the gross profit, does it help? What is the total variable cost? And the fixed overhead is that. Trying to figure out the best way to work out the variable cost. Remember, the total cost is equals to the variable cost plus the fixed cost. Okay, so let's go to our Excel. So please help me memorize these amounts. Help me memorize these amounts. The markup in this case is not the gross profit markup, it's the net profit markup. The markup is the net profit markup. So again, I think it's an easier one, we can work with it. So the markup is the net profit markup. So net profit markup. Lisa? Net profit markup. So the margin, in this case, if we say okay, so margin, in this case, because we are given net profit markup. So if you say margin times the selling price is equals to net profit, because it's not gross profit margin, this is net profit margin. So our margin, we calculated that to be 20 over 120 times our selling price, it was 6 what? Was it 672? So what is our net profit? 20 over 120 times 672.
One, 112.
112.
It's
Yes, 112.
0.
Okay, then, so if you say the selling price minus profit, you get cost. We did talk about something similar to this when we were doing target costing yesterday. So from your selling price, if you remove your profit, you get your cost. So from the selling price, if you remove your profit, you get your cost. So if you are selling something at 672, but the profit is 112, how much would have been your cost? If you sell something for 672 and your profit is 112, how much would have been your cost? Yes, Mr. Barry? Or anyone, please, let's be fast.
560, sir.
560.
Yes.
So having 560 as our cost, the cost of the business are broken into two. They are variable and fixed costs. These are the costs of the business. We have variable and fixed costs. So we are told the costs are 560, but the question is saying how much are variable. We don't know the variable, but we are also told the fixed costs. How much were the fixed costs, by the way? How much was the 320? Is it 3 or 220? 220. Are you saying 220 is the final answer or what? So the fixed overhead cost of the job
I'm
is
saying 220. Hello.
Okay. So the fixed cost, it was 340. So it means if you make that the subject of the formula, it becomes 220. That's our variable cost. So the variable cost is 220. That's correct. Now let's move on. Which of the following statements about the principal budget factor are true? So when we are producing, there can be a factor which limits us from producing to our maximum capacity. So that which is limiting us from producing to our maximum capacity, could it be labor? Could it be material? Could it be demand? That is said to be a principal budget factor, or we can call it a bottleneck resource, or we can call it a limiting factor. So which two of the following statements about the principal budget factor are true? The principal budget factor, it detects the minimum level of budget production possible. It restricts performance. Yes, I think it restricts because it's limiting us. It restricts the performance because we can't go beyond that level. If it's material, we can't go beyond we can't produce with more material than we have. So it restricts us within that period. It is the lowest level, it is the lowest level of sales that an organization can achieve in the period. Not lowest we can achieve, but it should be something that limits us. It affects the order in which the organization prepares the budget. Yes, if we have done limiting factor, in limiting factor analysis, you produce basing on the one that gives you the higher profit per limiting factor. So if you have a resource that is acting as a limiting factor, it determines your production plan. You start by producing that. If your material is limited and you are producing product A, B, and C, maybe let's go to our Excel and talk about this. Okay, so you have you got a job and a job offer to work for company A, company B, and company C. Company A is offering you, company A wants you for 5 hours. They want you for 5 hours. Company B, they want you for 8 hours. Company C, they want you for 6 hours. Okay, so company A wants you for 5 hours, B for 8 hours, C for 6 hours. And company A is willing to offer you $500. And company B is saying we can offer you $550. And company C is saying we can offer you $540. And the maximum hours you can work per day is 8 hours. What would be your option? You can't work for all of the companies because you can work a maximum of 8 hours. And these are the prices that they are offering. So if it was you, what would you do? Danai, what would you do?
I would go for A.
And I would go for A.
Yes.
Okay, others, what's your take on this? So the issue is the hours are limited. The hours are limited, so they're actually a limiting factor. So if you're faced with a limiting factor, you need now to make the decision of sacrifice. You have to choose if it was a product. Let's assume A, B, and C are products now. You would choose a product which is giving you what you call a higher return per limiting factor. You would say, okay, if I go to A, how much are they paying me per hour? So if I go to A, they are paying me $100 per hour. If I go to B, they are offering me something like $68 per hour. If I go to C, they are offering me something like $90 per hour. So A is giving me a higher return from the limiting factor. So I would take, because I'm available for 8 hours, I would take my 5 hours and use them in company A. Then the remaining 3 hours, I go and work in company C. So in that case, I have maximized my return from the limited hours. So it means I won't use any of the hours in company B. So that's why I'm saying that. In the case of the limiting factor, let's go and look at the last point now. The limiting factor, it affects the order in which the organization prepares its budget. So it means now we are going to prioritize A, followed by C, we end with B. What is gave rise to that order is the limited resource. Now let's move on. You are very late.
Hello, sir.
Yes, Bowen.
This question falls under which topic? I just want to revisit.
Should be limiting factor, or it could be budgets. It's under budgets.
Okay.
Okay, let's move on. A company uses marginal costing. The following variances occurred in the last period when the actual net profit was 40,000. A company uses marginal costing. The following variances occurred in the last period when the actual net profit was 40,000. So we have the actual and we want to go back to the budget. So we are given the actual and we want to go back to the budget. So if you are given the actual results and you want to go back to the budget, you do the opposite. You add the adverse and you less the favorables. But if it was from budget, so we can say, let's go to our Excel. It's not this one. So we're saying budget plus variance, or budget plus favorable variance. Is equals to actual results. Then the budget, you add the favorable, or let's put it this way: budget plus favorable variances minus adverse variances. So if you take your budget, you add the favorables, you less the adverses, you get the actual results. What about if you are coming from the actual? If you make the actual the subject of the formula, those that are fond of maths like me would say the actual results plus adverse variances. Minus favorable variances. Is equals to the budgeted results. So in this case, we are given the actual profit and we want to work out the budgeted profit. So we would say the actual profit, which is the actual result. Let's just go to the question. We are saying the actuals plus the adverses less the favorables. So can you quickly do that and let me know of the answers, please? So you're adding the favorables, you less, so you're adding the adverses, you less the favorables. Sorry? Okay.
$39,200 ilibwera.
39,200.
Ilibwere.
There it is. And they're saying it's correct. So I guess you are correct. Let's move on. Identify whether each of the following statements about the use of big data analytics is true or false. Do you know about big data? Big data and big data analytics. So big data, this is data that is large, that cannot be processed using manual tools. So big data, this is data which is large, that cannot be processed with manual system. So if the organization is processing big data, they are able to manage large volumes of data. For example, let's think of Econet. What would be the situation if they were recording the contact details? Maybe if they are using let's think of them using books to record the numbers. There'll be a lot of confusion. Think of if they want to contact a person, they have to go through the directory one by one, trying to figure out whose number is this one. And so because of big data analytic tools, they are able to handle large volumes of data. So big data can be seen by what? Data can be said to be big data because of its volume. That is, if it is of large quantities. So there are 5 V's of big data. Data can be said to be large because of its volume. It can be large because of its velocity, the rate at which we are receiving the data a second. The data can be large because of its velocity. Data can be large because of its variety. Variety, we are looking at the different forms in which the data is being received. The data can be large in terms of it coming in different forms. If the data is being received in different forms, it can be classified as big data. Data can also be classified as big data because of its veracity. Veracity of the data is its accuracy. If it's accurate data, it can be regarded as big data. So big data is data that we are receiving in large volumes. It can be data that is a high velocity, data that is a high veracity. It's coming in different forms. Sorry, veracity, it's of high value. Variety, it's coming from different sources or in different forms. Then, because it is of high value. So these V's are the V's of big data. If we can say this is big data, we can say it's big data in terms of this. If the organization is able to process large volumes of data, this can help the organization manage its customer behavior. Big data can help the organization monitor its customer behavior. So if the organization is dealing with big data, it can help the organization monitor the customer behavior. If you are able to process large volumes of data, you can be able to tell, like, let's think of an organization like Facebook. Facebook makes money through, nowadays there's this Facebook boosting where they sponsor adverts. So they have large volumes of data. They can be able to monitor how, if you can realize, if you maybe click an advert, a certain advert, you realize that after that, they will be sending you a lot of adverts that are of that nature. So they can monitor the behavior of customers to say, okay, now people are interested in this. By them being able to process large volumes of data, they can be able to monitor and see, okay, what is it that people are clicking these days? What is it that they're interested in these days? They can be able to monitor all that. So they can then sell that data. If you want the information, or if you want them to market for you, they can charge you a fee. Then they can market on your behalf. They can be able to tell, okay, these are the people that are interested. If it's ACCA, these are the people that normally click adverts for ACCA. Then they send the advert to you. So by having large volumes of data, they are able to monitor the behavior of the clients. So having access to large volumes of data as a company, we can be able to monitor the behavior of our clients, and we can use it even for marketing purposes. We can be able to market easily knowing the behaviors, or we can be even able to make better decisions because we have access to large volumes of data in the market. So having or being in access to large volumes of data is an advantage to the company. Now, let's now look at the question. So identify whether each of the following statements about the uses of big data analytics in an organization is true or false. It helps understand customer behavior and preferences. Being able to manage large volumes of data will help us understand customer behavior. Is that true or false? Let's be fast, please. Is that true or false? It's true. It helps to analyze the efficiency of the business processes in real time. It helps to analyze the efficiency of processes in real time. That one is also true. We can be able to analyze our performance in real time. So that one is true as well. So if it's being done in real time, we are looking at what is currently happening. It can give us live data of what is actually taking place. So it gives us data that is currently taking place. Okay, let's move on. So calculate the discounted payback. Payback period is easy now. So this one is yours to try. Quickly, can you try that? The payback period. Okay. Quickly, please. Can you quickly work that one out? Yes, I done. Can I have the answers? Time is moving, guys. Okay, time up. I think, can I have the answers or let's do it together? It's either you know or you don't. So calculate the discounted payback to the nearest 0.1 years. So the payback period, remember, is just the period we take before we recover our money. So if you invest money today, how long does it take before you recover that money back? So we look at our cash flows, 35, 45, 60, 75, 80. Just a moment. Just a moment. It's fine. Okay, now let's proceed. Sorry for the disturbance. So 35,000, 45, 60, 75, and 80. 35,000. 35 what? What is the next one?
What 5,000?
35, 45, 60, 75, 80. Okay, 35, 45, 60.
Sixty.
Then what?
75.
75. Then what's the discounting factor for the first year?
$0.909.
0.909. Second year? Zero 0.826751683. 826. I'm taking the cash flows, you multiply them.
$751.
Last one. 68.
3. That's not the last one, said. There's also year 5 for 8,000.
80,000 or 80?
80,000.
Okay. So the discounting factor 0.6.
21.
So for the payback, we are saying how long do we take before we recover? How long does it take before we recover our investment? Investment is 100,000. So how long do we take before recovering the 100,000? So it's minus 100,000. Then we start adding back. The first year we're going to add back. So you're saying minus 100,000, we add back. Oh, it's supposed to add. Yes, that's right. So we're saying minus 100,000, you add 31,815. So after the first year, you haven't recovered. Then we get to the second year. So second year, or rather, let's do this. So after first year, you haven't recovered. Then the second year, you're saying this one plus 37. Again, second year, you haven't recovered. Then, but in the third year now, Maria Orgu receiver is higher than Maria Sara to recover. So Gorere Guti Maria Orgu receiver is now more than Yasara to recover. You then say Yasara, which is 31,015 over yakapinda yacho 45,060. So that becomes 0.688. So it means to pay back, it takes us 2 complete years and 0.688 of a year. The question was saying round to 1 decimal place. So that becomes 2,0. So we're saying 2 years plus is 2 years plus 0.7. So that would be 2 years, 2.7 years. So the payback, it would be 2.7 years. Or if you are putting it in months, you would say 2 years, then you take this one, you multiply it by 12. So in months, it would be 2 years, 8 months. But the question said, it didn't give you option to give in years and months. So you just leave the answer in years. So if you're giving the answer in years, it would be something like 2, let's try 2.7 and see. Yes, 2.7 is correct. Yes, you can ask. The 10% ndo yavakashandisa kuwana ma-discount factors. So the 10% cost of capital is used to calculate the discounting factor. So why did we discount the cash flows? It's because the question says discounted payback. But otherwise, the normal payback, it doesn't discount the cash flows. I'm going to tell her as they are given. And take note, cash back, if you are using the payback period, net present value, IRR, these methods use cash flow, not profit. If you are given profit, adjust that to cash flow. So there's a difference between, don't just say the amount given. You need to check the profit or cash flow. The difference is that cash flow minus depreciation gives us profit. So if you are looking for profit, you say cash flow minus depreciation. But if you are given profit, you say profit plus depreciation. Profit plus depreciation is cash flow. Which methods use cash flow is the payback period. We have the payback period, we have the NPV, we have IRR. These use cash flows. Then which ones use profit? The methods that use profit, the ARR, the ARR in fact, is the one that uses profit. Now let's move to the next question.
Sorry, sir.
Yes.
I just want to ask you how to calculate discount factor.
The discounting factors.
Let's say we have given 20%.
Okay, let me check first if the formula is given in your formula sheet. So in your exam, you can, there is this bar here. You can check the formulas here. I think you don't need to use you can just use the table because you'll be given this formula. But however, if you want to calculate it, you can use the formula. So this is the formula for calculating the present values. 1 plus R to the power minus A. But it will be given, like for 10%, those discount here are the 10% present values. So I don't think they'll give you something, at this level, they won't give you something that you need to. So you just come to 10% if it's 10%. If it's 11%, you just come for 11%. Yeah. But however, if you want to calculate it, you can use the formula 1 plus R to the power minus A. Is it okay, or you still want to see how we can derive?
I think we use a table very fast.
And so that's fine. A company manufactures and sells a single product in 2 consecutive months. The following, a company manufactures and sells a single product in 2 consecutive months. The following levels of production and sales occurred. The opening inventory for month 1 was 400 units. Profits and losses have been calculated for each month using both absorption and marginal costing. Which of the following combinations of profits and losses for the 2 months is correct? Absorption costing for month 1, 200. Profit for marginal, 400 for first month. Month 2, absorption costing, that. Okay, what principle are we using here? The principle that we are using here, remember, I gave you that principle last lesson. Let's check if it's the same, if we are using the same slide. Let me check that. So, here, if closing stock is rising, absorption costing reports a higher profit. So if the closing stock is higher than opening, absorption costing reports a higher profit. If closing stock is higher than opening, absorption costing reports a higher profit. Then it's vice versa if it's falling. So I gave you also the reason behind. I said absorption costing reports at total production cost. So if the closing stock is higher, it means that we are going to report closing stock at a higher amount, of which closing stock and profit, they have a direct relationship. If you record a high value of closing stock, you record a high value of profit. So meaning that, using that same concept, if closing stock is higher than opening, absorption costing reports a higher profit. If closing stock is lower than opening, marginal cost reports a higher profit. So can you try to use that guide to try to figure out the answer? Let me not spoon feed you. Can you try?
Production 3.9. So production 4.2 sales. Is lower. Then
I can turn off your mic so that you won't hear your background. Okay. Can I hear the answers now? Let's save the first one, first month. Which one is higher first month? Is it the opening or closing stock? Is it the opening or closing stock one? Oh, what's the closing stock for month one? What's the closing stock for month one? So I think that's where the problem is actually starting. So determining the closing stock, you say you started with 400 units, right? Even in the basic logic behind, you started with 400 units. And you produced how many units? 300. So if you started with 400 and you produced the 300, how many units did you have? Let's talk. Let's please have an open dialogue. Can you please respond? So you started with 400 and you produced. It's 3.9. So you started with 400 and you produced 3.9. It means how many did you have in total after that?
4.3.
4.3. And then you sold 3.8. So how many did you remain? Hello, you said how much? Are you guys with me or not? So it started with 400.
500.
So we have 500. So it means the closing stock is higher than the opening, right? So for month one, the closing stock is higher than the opening. So it means for month one, we should have a higher profit under absorption than under marginal. So the profit under absorption should be higher than the profit under marginal. So under absorption should be higher. So the first statement is saying the profit is higher under absorption month one, which is, then we go for month two. So two is actually wrong. Why? Because it's saying for month one, the profit for absorption is less than the profit for marginal. Remember, if the closing stock is higher, absorption profit is higher profit. So our answers is between A and C. It's between A and C. Now, what is the closing stock for month two? What is the closing stock for month two? Remember, the closing stock for month one is the opening for next month. So what is the closing stock for month two?
500.
It's 500. No, are you sure it's 500? Because we started with 500, is it? And we produced 4.2 and we sold 4.4. It can't remain 500. We started with
300.
500, produced 4.2, it becomes 4.7, you sell 4.4. How many do you remain with?
300.
300. So the closing stock is less than the opening. So it means for month two, marginal costing should report a higher profit. So month one is absorption costing, reporting a higher profit. Then month two, it is marginal. So for month one, absorption costing has a higher profit. Month two, marginal costing has a higher profit. This one is, so I think the first one, because the second one is saying, again, for month two, absorption profit is a higher profit, of which no. For month two, absorption profit is has a lower profit than margin. So it's using that principle of knowing kuti. If closing stock is higher, then it reports a higher profit. The following statements relate to advantages that linear regression analysis has over high-low method. So when you are predicting the overhead, we can use the linear regression analysis, or we can use the high-low method. So the linear regression, this is when you're using regression analysis. It tends to take into account all the data. High-low method just identifies the highest and the lowest. It eliminates some of the data, but linear regression takes into account all the data. Then, from the answers that we have here, the reliability of the analysis can be statistically tested. So regression, yes, we can test the relationship of the data. In regression, that's where we can have the strength of the data being tested with the correlation. So I think one can do. It takes into account all the data. Yes, regression analysis takes into account all the data. Let's try 1 and 2 years. So it assumes the linear cost behavior. So in regression analysis, because in regression analysis, we are looking at Fanatriba regression analysis. I'm trying to, because in this case, the following statements relates to the advantages of linear regression that it has over high-low method. I'm thinking both assumes the same. Even in high-low method, the cost behavior it's a linear relationship. So the one that it has over if we are looking at the advantages that the linear regression has over the high-low method, it means it must be something that is not also there for high-low method, of which they both assume. Which of the following examples are direct data capture costs? So the costs associated with extraction of the data, feeding it into our system. So it's extraction of data, which can be the cost of extracting the data, capturing the data into our system. The direct data capture costs, the costs associated with capturing the data. What do you think? So under data capture costs, this one, if you are barcodes, taking the data or using the capturing the data from barcodes, it's data capture cost. So the cost of capturing, so you have the data that we are going to capture the data into our system. So that paneda kutengesa chino, pachinongoya system, data racho neragara ritorimo system data. So that cost of capturing the data, putting it into the system, that one is part of data capture cost. I think from this list, what else? Payroll, department processing, employee cost, completion of timesheets, finance staff preparing sales report, no. So cost associated with extraction of data here should be, I think, completion of my timesheets. We are extracting the data. So the costs associated with extracting the data, inputting that data in the system. Which of the following would not be expected to appear in the mission statement, the long-term targets of the entity, our mission as an entity? So what can we say? This one is not are relevant to include it in our mission statement. So what? Is not expected, okay? So Noko said A, and A is wrong. So it's not A. So which should not be expected. So in our mission statement, it's a long term. We are talking about the long term. Yes, because if it's the mission statement, it's the
G.
It's the long term. So we can't include the short term targets. Sorry? If we are looking at the long term, so we're saying we are planning for the next 5 years. We have to consider who, because if we are looking at the long term, you have to consider the stakeholders, such as what is the government going to be saying? What is, well, stakeholders are all we have investors, they are stakeholders. We're not looking at the customers, but we're looking at all those that are going to be affected by our business. So we can't come up with a long-term plan without looking at its impact on those that are going to be affected. If an employee produces 200 units in 8 hours on a particular day, what is the employee gross pay? An organization operates a piecework system of remuneration, but also guarantees its employees 80% of a time-based rate of pay, which is based on $20 per hour for an 8-hour working day. 3 minutes is standard time allowed per unit of output. Piecework is paid at a rate of 18 per standard hour. If an employee produces 20 units, okay, let me give you a minute to digest the question and try it. Maybe let's say a minute and a half for you to read and attempt. So that should be very fast. Quickly try that. Time is now running out. Okay, so let's finish up with this one. Anyone who has managed to come up with something? Anyone who has managed to come up with something? So the employee produces 200 units in 8 hours on a particular day. And employees if an employee produces 200 units on a particular day, what is the employee gross pay? So in that case, the gross pay, it is because they are being paid per what? They are being paid Three minutes is the standard time. So if you're looking at the gross, you base on the standard. So we base on the standard. So we are going to say the 3 minutes times 200 units. 3 minutes times 200 units. How long is that? 3 minutes times what? 600. Then having 600 minutes in terms of hours, because they are being paid 18 per hour. 600, you put that in hours, you multiply by the rate per hour. $10.8. Saying 10.8 for what? Because I entered 600 minutes and it, but 600 minutes in terms of hours, that's what? Divide by 60, that's 10 hours. So it's supposed to be something like 180. We base on the standard. The gross is based on the standard. The net is what we take into account the change. So the gross, then that's something like 180. Okay, I'm now preparing to get into another lesson. So I will resume from there tomorrow. Remember our Sunday sessions, they have been adjusted to start at 12. So from the normal timetable, we are adjusting for Sunday. Let's start at 12 because I have another lesson in the afternoon. So for tomorrow, our lesson starts at 12. So thank you so much. I'm now logging out.